Hey, and welcome back to Lucid Equity, where we turn the confusing parts of money into one clear, simple move. In 1999, a man put less than $2,000 into a retirement account designed for the middle class. 20 years later, that account was worth $5 billion. And here is the part that should stop you cold. He will never pay a single cent of tax on any of it. His name is Peter Thiel, and the account was a Roth IRA, the exact same account you could open this afternoon. To be clear about the scale of that, $2,000 becoming $5 billion is a return of 2.5 million times. Nothing on the public stock market has ever done that, but the account that held it is one almost anyone can open. This is a true story, pulled from leaked IRS records by ProPublica. Thiel used his Roth to buy shares of PayPal, Facebook, and Palantir back when they were worth almost nothing, inside an account where growth is never, ever taxed. $2,000 became $5 billion, completely tax-free. Today, I'm going to show you the exact strategy he used and the versions of it that you can actually use too. Start with the one idea that makes all of this work. A Roth flips how tax normally works. With a regular account, you save on taxes today, and then the government taxes every dollar you pull out in retirement. A Roth does the exact opposite. You pay tax on the seed, the money you put in, and then never again. Not on the growth, not on the withdrawal. You tax the seed, not the harvest. So let's define it clearly. A Roth IRA is a retirement account you fund with money you have already paid tax on. In exchange, every dollar it earns for the rest of your life comes out completely tax-free. No tax on the dividends, no tax on the gains, and no tax at all when you withdraw it in retirement. Watch what that is actually worth. Put $7,000 a year, roughly the annual limit, into a Roth for 30 years at 8%. You end with about $869,000, and you keep every single penny. Put that exact same money in a regular taxable account, and capital gains tax quietly eats around $100,000 of it. Same money going in, tax-free coming out is just, mathematically, more. And that gap only widens with time. Because taxes don't just take money once, they take the future growth of the money they took. Every dollar the tax man removes today is a dollar that never compounds for you again. And it gets better. A traditional retirement account forces you to start withdrawing money at a certain age, whether you want to or not. Those are called required minimum distributions. A Roth has none. You can let it compound untouched for your entire life, and even pass it to your children, still tax-free. It is the single most tax-efficient account that the law allows. So here is the obvious question. If a Roth is this good, why doesn't everyone simply max it out? Because there is a catch written right into the rules. If you earn too much money, you are legally banned from contributing to a Roth directly. In 2025, that door starts closing around $150,000 of income for a single filer and slams shut just above it. Which sounds like it locks out the exact people this video is about, the high earners, the wealthy. Except it doesn't, because the rich quietly found 3 completely legal ways to get through, around, and over that wall. Let's walk through all 3. Strategy 1. The Backdoor Roth, the move that gets high earners straight past the income limit. Here is the loophole. There is an income limit to contribute to a Roth, but there is no income limit to convert a traditional IRA into a Roth. So the move is simple. Step 1. Put money into a traditional IRA, which anyone at any income is allowed to do. Step 2. Immediately convert that traditional IRA into a Roth. You just walked through the back door. The IRS knows about this. Congress has left it legal for years, and high earners do it every single January. And to be completely clear, this is not a gray area trick or some risky scheme. It is a documented, widely used, above-board strategy that financial advisors set up for high-income clients as a matter of routine. One honest warning: if you already have money sitting in other traditional IRAs, the tax man applies something called the pro-rata rule, and your conversion can trigger a surprise tax bill. The clean version works best when you don't have large pre-tax IRA balances. This is the one step genuinely worth asking a tax professional about before you pull the trigger. Strategy 2. The Mega Backdoor Roth, the one that moves the most money, by far. If the regular backdoor moves $7,000, the Mega Backdoor moves 10 times that. Your 401k has a little-known third bucket, after-tax contributions. In 2025, the total that can go into a 401k from every source combined is $70,000. Subtract what you and your employer normally contribute, and the leftover room, often $30,000 to $40,000, can be added after tax and then converted straight into Roth. That is tens of thousands of tax-free dollars a year, stacked on top of everything else. Think about what that unlocks. Someone who is already maxing out their normal contributions can potentially trench another $30,000 or $40,000 a year into a tax-free account. Money that, over a career, quietly becomes millions that the government will never touch. The catch is this: your 401k plan has to allow two specific features: after-tax contributions and in-plan Roth conversions. Many large employers allow it, plenty don't. So the single most valuable question you can ask your HR department this week is simply, does our plan allow the Mega Backdoor Roth? For a high earner, that one answer can be worth a fortune. Strategy 3. The Self-Directed Roth. The exact strategy at Bill Peter Thiel's $5 billion. A normal Roth holds stocks and funds. A self-directed Roth, held at a specialized custodian, can hold almost anything the law does not specifically forbid, including shares of private companies, before they ever go public. Thiel bought founder shares of PayPal inside his Roth for a fraction of a cent each. When that company exploded in value, every bit of that growth happened inside the tax-free wrapper. That is the entire trick. Put the asset in before it is worth much and let the moonshot happen where taxes simply cannot reach it. And this is the piece almost nobody understands about how the ultra-wealthy actually build tax-free fortunes. It was never about hiding money. It was about placing an asset with astronomical upside inside a legal wrapper before the upside happened. Now be honest with yourself. You probably commit by PayPal. That kind of access is what being an insider actually buys. But the principle scales all the way down. A self-directed Roth can also hold real estate, private lending, or a stake in a small business. The lesson is not go find the next SpaceX. The lesson is put your highest growth assets inside the one account where growth is never taxed. And here is the deeper reason the wealthy love the Roth so much. Most tax breaks hand you a deduction. They save you a little tax today on a small amount of money. A Roth gives up that small deduction now in exchange for zero tax on a potentially enormous amount later. Anytime you expect an asset to multiply, you would always rather pay the tax on the tiny seed than on the giant harvest. That one insight is the whole strategy. Put a hard number on it. Contributing $7,000 to a Roth costs you, at most, about $1,700 in tax today, because you fund it with money you already been taxed on. In return, the roughly $869,000 it can grow into is never taxed at all. You paid tax on $7,000 to shelter nearly $900,000. That is the trade the rich make, on purpose, every single year. Flip that ratio around in your head. You are voluntarily paying a small, certain tax now to erase a massive, uncertain tax later. For any asset you genuinely believe will grow, that is one of the best deals in the entire tax code. So there they are, the three strategies. 1. The Backdoor Roth, to slip past the income limit. 2. The Mega Backdoor Roth, to pour tens of thousands more in through your 401k. And 3. The Self-Directed Roth, to hold your biggest winners where the IRS can never follow. It is the same account the middle class was handed. The rich just use it with intent. So here is your actual move, starting today. If you qualify, open a Roth IRA and fund it. For most people, that alone is the entire game. If you earn too much to contribute directly, use the backdoor. And ask your HR department one simple question: does our 401k allow the Mega Backdoor Roth? You do not need $5 billion for this to matter. You need to start the tax-free clock as early as you possibly can. Here is the whole thing in one line. The rich don't have a secret account. They have a better strategy for the same account you already have access to. Pay tax on the seed, never on the harvest, and put your biggest winners where the growth is free. If this finally made the Roth click, subscribe. One confusing money topic made simple every single week. And tell me in the comments, are you using a Roth yet? This video is for educational purposes only and is not financial or tax advice. Contribution limits and income thresholds change every year, and strategies like the Backdoor and Mega Backdoor Roth carry rules, including the pro-rata rule, that can create a real tax bill if done incorrectly. Talk to a licensed tax professional before you act. So if this helped, do 3 quick things. Hit that like button, share it with someone who's quietly overpaying the government, and subscribe for a new money breakdown every single week.